Markets are acting crazy again. Let's go over our team's research at MacroOps to see what's going on and where we think things are headed from here. But man, the volatility really has not stopped since 2018. It's almost 2 years now of these markets that are just flinging us all around. And if you're getting tossed around, don't feel bad, because like I said, these are tough markets. But they're even tougher if you're not using a trading system, because, you know, I don't know, if you're discretionary, I don't know how you'd be trading this. If back when I was discretionary, if markets were like this, man, that would be rough. Not to say the systems are perfect or anything. I mean, I'm still getting tossed around a little bit in and out, but at least I don't got to worry about what Trump is going to say next and try to evaluate based off that. Anyway, one of the first steps to having a good system is having your systems trading checklist with you. So if you're not using a checklist, download this one right here that we got for you for free. It's our systems trading checklist that we use to run our systems, and it can really be applied to any strategy. All you got to do is click the link down below in the comments and you'll be taken to this page where you can put in your name and email, and I'll send that over to you right away. And it also comes with a training that we did, a video training, to show you how you use it, and it kind of shows you how we use it as well. And I know I've told you guys about this before, but we've actually redone the whole thing, both the checklist and the training. So even if you've gotten this before, make sure you check it out again, because it's different now, it's better. But anyway, let's get back to this research. So first off, Trump throws in the towel on the trade war. He calls a little truce. It's at least short term for now. Now, we're not really going to go over whether the trade deal is good or bad, because it actually doesn't matter as much for us. What we're concerned with is how it affects the market. So a temporary de-escalation in this trade war does help the market because it reduces some of the uncertainty. Because like I said, you never know what's going to happen with Trump and his tweets in China, and having that floating over the market all the time introduces a lot of uncertainty, and uncertainty is bad for markets, and it's bad for businesses in general. Like, for example, the executives trying to run their day-to-day operations and trying to plan and invest for the future. Well, that's tough to do when you don't know what's going to happen between the US and China. So this pause in the trade war should help lead to a rebound in the data we've seen over the last year. Remember, uncertainty is bad for the market, so calming down the uncertainty is good. So based on the sentiment charts, we think a bottom in the market is in, and the market should trend higher from here. But let's go over it. Here is the put-call ratio on the S&P. So this red line right here is the 50-day moving average of that put-call ratio, and you can see it's one standard deviation above its mean. So again, this means that a lot more investors have puts than calls, and puts are the right to sell. So if you're buying a put, you think the market is going to go lower, which means they are pessimistic. And the last time the ratio was this bad, with this many puts versus calls, and usually when the ratio is this bad, this many puts versus calls, it marks a bottom in the market. Because remember how sentiment works. The more negative the sentiment, the better for the market, because bull markets don't die on pessimism, they die on extreme optimism. Like the 2008 housing market, everyone was so excited about houses and real estate. Or 99, the tech bubble, everyone wanted to buy anything with .com on it. Bitcoin, same thing. Bull markets turn on euphoria. So pessimism is a good thing. That means prices will continue going higher. So if we look at the bull bear sentiment chart, that's hitting extreme lows too. People are very, very bearish, as you can see in this yellow line, and the red line, which is the average, that's hitting lows that usually marks the bottom in the market. Then our MacroOps proprietary composite sentiment index, well, that was really high last week. People were way too bullish, but now it has dropped below this red line, which means people are very bearish, confirming the other things that we were just talking about. So whenever this index falls below this red line, that gives us a buy signal. Just another reason why we think the market is going to keep heading higher from here. So if you put all this together, basically the data is saying that the majority of the market is incredibly offsides and under positioned for any possibility of a rebound in economic data. Again, they're so pessimistic that they're super bearish and don't have their money in, which means there's a lot more fuel to send prices higher when they eventually do get in. A reversal in the year-to-date relative flows between stocks and bonds could kick off a bullish feedback loop where stocks, after mostly going sideways in the US and lower in global markets for the better part of 2 years, which is, like I said, since 2018, would begin a renewed global rally in risk assets. So remember, stocks and bonds, they compete for money. So if yields are low in bonds, then people don't want to put their money there because they aren't going to get a good return. So instead, that money flows into stocks, and vice versa when yields are higher. So you can see the rate of change in the 10-year yield right now, it is dropping fast, which means that people aren't going to get a good return there. They're going to put their money in stocks where the return is better. So what our team at MacroOps thinks, and you know our head researcher there is Alex, he thinks that the catalyst that will kick off this next trend higher is earnings coming out this week. Right now, consensus expectations for earnings earnings, which means, you know, what all the analysts are thinking, they are very, very low. So these analysts are super bearish, saying that these companies are going to report some terrible earnings. The average estimate for EPS growth among those analysts is negative 3.2%. So it's a very low bar for these companies to potentially exceed expectations, because markets, again, are all about expectations, right? How a stock moves after earnings. If people's expectations are exceeded, then the stock price is going to go higher. If expectations are met or they fall below, you often see the stock price go lower. So if there's this low of a bar, there's a much higher probability of those expectations being exceeded. So like Alex says, it's not going to take much to positively surprise analysts and force them to revise their expectations higher, which again will send prices higher. So keep an eye on earnings this week, because that is probably what's going to send prices higher. And if you haven't already, make sure you get your free checklist. That link is down below. It's worth it. Check it out. It's free. And also make sure to subscribe to this channel and hit that notification bell so you get an email notification whenever our new videos come out. We're going to start publishing more videos again because I'm back on the channel finally. So subscribe, and I'll see you in the next video. Stay fallible out there. Bye.